Global stock markets are in full sell-off mode today, with Wall Street's main indices plunging further down. The sell-off follows last week's weak jobs report in the United States, triggering fears that the U.S. could slip into recession. Investors panicked, and the Dow Jones Industrial Average was down 1.7% at the open. Fears of a recession have sent shockwaves through many global markets, including India, Brazil, and South Korea. Now, this first sign of a bad day was in Japan, where the Nikkei suffered its second worst decline ever on Monday. The benchmark index fell 12.4%, not far off the worst one-day decline for the Nikkei, which was almost 15% on October 19th, 1987, that day known as Black Monday. European shares also hit near six-month lows. All right, joining me now to discuss what is happening today and hopefully put it into perspective for us is Jim Stanford. He's an economist and director with the Center for Future Work. Jim, hello to you.
Hi, Marcia.
Why is this happening now? There's a whole bunch of factors, geopolitical instability. We talked about Japan, the U.S. holding off on interest rates. What is your take?
Every time the stock market crashes, Marcia, people always look for the proximate cause. What was the little thing that happened the day before that caused this kind of hissy fit in markets to break out? And we can see some proximate causes here. The obvious one is the latest data on employment from the U.S. was disappointing. Not that negative, but not as good as people had hoped. And that raised fears that maybe the U.S. economy, which has been the leading light, if you like, in the global economy over the last couple of years, maybe the U.S. economy was heading towards a recession. We saw in Japan, after years of trying to buck the trend of higher interest rates, they kept rates very low in Japan. But last week they did raise interest rates, and that's always bad for the stock market and can have repercussions in currency markets and elsewhere. But at the end of the day, Marcia, this really is just in a way a recognition of the fragility of the stock market boom that had occurred over the last couple of years, especially in tech stocks. The AI, artificial intelligence excitement drove up shares in companies like NVIDIA and, of course, the traditional tech stocks, Apple and Microsoft and Intel. They're all falling very dramatically right now, which shows there was a bit of a bubble effect there. And this is probably what's driving the bigger downturn that we're seeing across world markets.
So do we call this then a correction, Jim?
Well, again, correction is in the eye of the beholder, if you like. It has crossed the traditional benchmark for what's considered a correction of over 10% decline from peak. So we saw that in one day in Japan. And we've seen it over the last couple of weeks in the NASDAQ, which is where the big tech stocks trade. What's the bigger question, I think, is whether it is just a correction or whether it's the start of a bigger downturn. And that will depend on things like the next bits of data from the U.S. economy and what the U.S. Federal Reserve does on interest rates. They're not scheduled to meet now until September. Unlike Canada, they have not cut interest rates at all yet. And they may be behind the curve on this. So I tend to think a bit of time and hopefully lower interest rates will put some stability back into these markets.
So I'm just about out of time then. On that note, could the U.S. do an emergency cut? What impact would that have on potentially stopping the bleeding?
Yeah, that's being speculated on now, and some of the traders on bond markets are hoping for that. That would be a very unusual move, and I think it will take more than just a couple bad days on the stock market to push the Fed to do that early. I think more likely we'll wait until September, and then I think we'll definitely see the first of several rate cuts beginning.
Jim, good to see you today. Thanks so much for your analysis.
Thank you.